Welcome to Beyond the Bottom Line, your go-to resource for actionable accounting tips designed specifically for small business owners. I am James Troy, an entrepreneur and student at DePaul University studying accounting and data science. Today, we're diving into an essential topic, depreciation. Did you know that failing to track depreciation properly could mean leaving money on the table? Whether it's your tax deductions, cash flow, or just understanding where your business stands financially, depreciation is a game changer for small business owners. By the end of this video, you'll know exactly how depreciation works, how to use it to your advantage, and how to record it correctly to stay compliant with IRS regulations. Let's begin with the basics. Depreciation is an accounting method used to spread the cost of tangible assets over its useful life. Instead of writing off the full expense in 1 year, depreciation helps small business owners allocate the cost of assets such as equipment, vehicles, or machinery across multiple years. Think about that delivery van that you bought for your bakery. It's not fair to count the entire cost as an expense the year you bought it because it'll help your business for many years. Depreciation spreads that cost over time. This makes your financial statements more accurate and reflects the true wear and tear of those assets. So why is it important to understand this as a small business owner? Well, the answer to this question is threefold. First off is tax deductions. Depreciation can lower your taxable income, reducing the amount of money you owe to the IRS each year. Secondly is accurate financial reporting. By properly tracking depreciation, you'll have a more realistic view of your business's expenses and profits, which can help you make smarter financial decisions. And thirdly is cash flow management. Depreciation provides gradual deductions that can help your business cash flow by spreading out costs over time instead of having to write off large expenses in 1 year. Now, let's talk about when assets should be depreciated. According to the IRS, an asset needs to be depreciated if it has a useful life of more than 1 year and it costs more than $2,500. Anything below this threshold, typically considered a small expense that can be written off immediately. So before we dive into the three methods of depreciation covered under GAAP, let's first go over some important terminology that you need to understand in order to do the depreciation calculations. So first off is useful life. The useful life is the estimated lifespan of an asset or how long it will be productive for your business. Next is salvage value. This is the estimated resale value of an asset at the end of its useful life. And finally, we have book value. The book value of an asset is the value that it holds after subtracting the accumulated depreciation. So let's take a look at an example that ties together all of these vocab terms. Say that I buy a new car for my business for $30,000. At the time of my purchase, I think that I'll be able to use the car for 10 years before I need to buy a new one. And after doing some research on my car model on the used car market, I made an educated guess that at the end of those 10 years, I could probably get $3,500 for the car. So in this example, my useful life is 10 years, the amount of time I think the asset will last for. And my salvage value is $3,500 because at the end of those 10 years, that's how much I believe I can sell it for. Now every year for those 10 years, I'm going to depreciate the $30,000 value of the car until it reaches a book value that is equal to my salvage value. Now that we understand those terms, let's walk through the three main methods of depreciation covered under GAAP that small business owners typically encounter. Those are the straight line, the double declining balance, and the units of production method. So first, let's talk about the straight line depreciation. Straight line depreciation is the simplest method and is the best for assets that lose value evenly over time. Here's how we calculate it. First, we determine the cost of the asset and its salvage value and subtract the two. Then we divide that by the number of years over which you plan to depreciate the asset, aka the useful life. This will give you a consistent deduction each year, which is easy to manage for your financial reporting. So let's take a look at an example problem using the straight line method. Troy Manufacturing Co. buys a piece of equipment for $21,000. This piece of equipment can be used for up to 10 years and has a salvage value of $2,500. Find the depreciation expense in 1 year using the straight line method. So first, we take the value of the asset, which is $21,000, and subtract $2,500, the salvage value, and divide that by our useful life of 10 years, giving us a depreciation expense of $1,850. So this means every single year, Troy Manufacturing Company is going to record a debit to their depreciation expense and a credit to accumulated depreciation for $1,850. So here are the benefits and downsides to using this method. The benefit is that it's easy to calculate and does not change every period. This makes it very easy to predict your future cash flows. The downside is it may not reflect the actual usage for assets that depreciate faster in the early years of use. Second, let's take a look at the double declining balance method. The double declining balance method is a method that allows for higher deductions in the early years of an asset's life. Here are the steps we use to calculate it. First, take 2 divided by the useful life of the asset, then multiply that number by the book value of the asset equal to its cost minus all its accumulated depreciation. Alternatively, you can calculate this amount by multiplying the book value of the asset by a fixed percentage that's usually set by the IRS. Let's look at the same example from last time, but now using the double declining balance method. Remember that this manufacturing company bought a piece of equipment for $21,000 with a useful life of 10 years and a salvage value of $2,500. So our depreciation expense in the first year is 2 divided by 10 times a $21,000 book value, which gets us a depreciation expense of $5,250 in year 1. Now, just to help you get a better grasp of net book value, let's also compute the depreciation expense for year 2. First, we need to find out our new net book value. Since we have recorded $5,250 in depreciation so far, we're going to subtract that from the $21,000 value to get a book value of $15,750. So our new depreciation expense for year 2 is 2 over 10 times our new book value of $15,750, resulting in a depreciation expense of $3,150. So you can see that in year 2, this number is much less than year 1, and it will continue to decrease as the years go on. So the benefits of using this method is that it gives you a larger deduction in the beginning, which can be helpful for cash flow during the early stages of an asset use. Additionally, since you're recording larger chunks of depreciation, it leads to a lower net income, which then leads to you paying lower taxes during that year. However, the downside is that deductions slow down as the asset ages, so it may not reflect actual usage in later years. Finally, let's look at the units of production method. The units of production method is ideal for assets that wear down based on usage, like equipment or machinery. This method calculates depreciation based on actual usage, like the number of units produced or hours used. Here's how we calculate it. First, we determine the cost of the asset and subtract the salvage value. We then take that number and divide it by the expected output in units or hours, giving you a depreciation rate per unit of production. And finally, we multiply this rate by the actual production for the year to calculate the depreciation for each period. Now let's use this same example we've been using, but this time record the depreciation expense using the units of production method. For this example, let's say that the equipment is useful for 40,000 total hours, and we actually use the equipment for 6,000 hours in year 1 and 9,000 hours in year 2. So to calculate the depreciation, we'll first take the cost, $21,000, and subtract that from the salvage value of $2,500, which gives us $18,500. Now we take that and divide it by the total expected hours we can use that equipment for, which is 40,000. This gives us a depreciation rate per hour of 0.4625. We then multiply that by our actual usage for the year. So in year 1, we're recording a depreciation expense of 2,775, which is 0.4625 times 6,000. And in year 2, we have a depreciation expense of 4162.5, which is 0.4625 times 9,000 hours. Now the benefit of using this method is that it can provide more accurate deductions if usage varies significantly throughout the year or across different years. In addition to these 3 depreciation methods, the IRS sometimes requires businesses to use MACRS, which stands for the Modified Accelerated Cost Recovery System. This method the IRS uses to calculate depreciation for most types of assets. MACRS has depreciation tables for different asset classes, which will give you guidelines on how quickly you can write off the cost of various types of assets over time. You'll find these tables on the IRS website. The tables vary based on asset type like machinery, vehicles, or furniture, and specify different useful lives and depreciation rates. When I was looking through the MACRS depreciation table, I came across a free website that has a MACRS calculation built into it. All you need to do is enter the cost of your asset, the life of the asset, and then answer the last question, which will ask you, has 40 or more percent of the asset with this MACRS life been placed in service during the 4th quarter of the year? And from there, it will give you a table with the depreciation that you can record during each year of the useful life of the asset. If you want to use this resource, I will leave a link to it down below in the description. Now at this point in the video, you might be saying, great, I understand how to record depreciation, but I still don't know where I'm supposed to record this on my tax forms. Depreciation is recorded on IRS Form 4562, Depreciation and Amortization, which you'll need to file annually along with your business taxes. Each year, you'll list your assets, calculate depreciation using your chosen method, and claim your deductions on your tax return. It's important to track depreciation throughout the year to ensure you're accurately reporting your expenses and maximizing your deductions. So there you have it, depreciation explained in a way that any small business owner can understand and apply. By understanding the basics of depreciation methods, knowing when to depreciate your assets, and learning how to accurately record this on your taxes, you'll be better equipped to manage your business's financial health. Keep in mind that depreciation is not just about accounting. It's a tool that can improve your cash flow, manage taxes, and provide insights into your asset performance. If you found this video helpful, be sure to like it, subscribe to Beyond the Bottom Line, and share it with other small business owners who need guidance on depreciation. If you've got any more questions about accounting or other topics, drop them in the comments below, and thank you everyone for watching.